If you are concerned about potentially high interest rates in 2024, you are not alone. While we hope that the rates would go down, and we speculate that it should go down, some people say in a year or two, some people say longer. Well, an article just came out in the Financial Post, and the trajectory doesn't seem like it's going to go down in the foreseeable future. And if it does go down, it definitely will not go down to pre-pandemic rates. Specifically, the Financial Post, with an article titled Post haste, borrowers feeling the strain as Bank of Canada says higher rates may be here to stay. It seems to indicate that at least for 2024, these higher rates are going to be with us. So let's take a look at some of the snippets from that article. Be prepared, the Bank of Canada said this week. The era of low interest rates may be over. Since the great financial crisis of 2008, interest rates in Canada have not risen above 1.75%, and during the pandemic, they sunk as low as 0.25%. It can be tempting to think those very low rates will eventually return, but there are reasons to think that may not happen, said the Bank of Canada's senior deputy governor, Carolyn Rogers, in a speech in Vancouver recently. Additionally, the article said, global forces that kept rates low may have peaked and could start reversing. Wars in Ukraine and the Middle East could escalate and push up energy prices and reignite inflation. The bank, through its own surveys, knows that Canadians are feeling the pressures of high borrowing costs and inflation, she said, with most homeowners still to renew their mortgages at higher rates. Policy makers are watching how they adjust. So essentially, the Bank of Canada, at least a representative from the Bank of Canada, seemed to indicate that for 2024, we will not be getting those lower rates, at least not the pre-pandemic rates. So today I'm going to talk about a few things that you could do to prepare for this, right? Specifically, we have 7 plus 1, so essentially 8. So let's get going. The first one is we go back to basics, folks. We review our budget, all right? And the goal there is to increase your savings to manage higher mortgage payments or other expenses if inflation increases again, or at least it maintains at the rate it is, which is not at pre-pandemic levels. So essentially, for those who don't know what a budget is, essentially look at your income, annual income, look at your expenses, and you see what you have left over. Now, what you have left over is either called a surplus, which means you have excess left over, or a shortfall. So if you have a surplus, what you want to do is increase savings such that you may want to look at ways you could lower your expenses. And you might say, well, okay, what's the process for that? The process for that is, I always say, categorize it into things you need and categorizing things you want. The things you need are typically food, clothing, shelter, right? And for those things, you look and see if there are ways that you could either negotiate those things. So for example, if you have certain rates for things you need, either a mortgage, we're going to talk about that, or if you have, you're paying car overhead, say you have a car insurance, you may be looking at renewing to see if you can get a lower amount. You do need your car, especially if you need it for work, then that's a necessity, right? Because it helps you to earn an income, but there may be ways for you to lower that. For the things you want, such as movie theaters, subscription like Netflix, or just going out, you look at that and see where you can lower it. Because the lower that your expenses are, then that means you're going to have more disposable income, which means you're going to have potentially more savings. And that's if you don't lower your expenses to take on more things, right? And if you have more savings, what you can do is use that savings to deal with higher mortgage payments or inflation in certain different areas, right? So the first thing we're going to do is review your budget. And if you haven't had a budget before, now would probably be a good time to get going on that. Next one is pay down high interest debt. And why is that? Because if you have high interest debts such as credit cards, etc., then what you're doing is a significant amount of your payment is going towards interest rates. And if you could lower that, then ultimately you're also going to be lowering the interest rates, the interest payments monthly, right? And excess that you would have been putting towards that card is what you potentially can be using in the future to put towards any increased mortgage payments, right? So next thing you want to do is pay down high interest debt. Build an emergency fund. Listen, you might say, well, everything is in place and I kind of plan for it, and the amount that I have now will deal with the increase that I have to deal with for mortgage payments, or if inflation continues to be a thing, I'm going to be fine. But what happens if you have an illness, you have an emergency, some huge expense you weren't planning for arises? Can you deal with that? And what you want to do is, if you have surplus from the budget and you start have savings, well, you want to make sure that you have at least 3 to 6 months worth of living expenses just put aside, right? And that's the minimum depending on your job. If you have a more stable job, kind of look at that. If you have a job that is more vulnerable, then you probably want to, increase that amount, right? So you want to consider that. And the big thing is, listen, if you have some type of a job loss, some type of setback, you could deal with that mortgage payment, and it gives you some, some breathing room. Next one is increase mortgage payments, right? Now and again, these are just suggestions. These are things to consider, right? If you have a bit of a runway, meaning that you're not renewing immediately, but you're going to renew sometime in the future, and interest rates continue on a particular trajectory, what you may want to consider is put a decent amount towards the principal. That way, when you renew, if you have to renew, then you'll have a lower payment because you'll have a lower principal, because your interest that you pay will be based on the outstanding amount. And if you lower that outstanding amount, then the potential there is for you to at least have a lower amount, something that's affordable, something that you could deal with in the future. Now, again, these are just suggestions, things to consider. You also want to look at opportunity costs. If that same money is something that you could be invested in an opportunity or property or something else that could provide you with excess cash flow, then you want to do the numbers and see which one makes the most sense. But I think this is especially important for individuals who are entering retirement. You don't want to enter retirement with a mortgage in most cases, unless that property is providing you with some type of a cash flow. So you definitely want to consider that, some type of payment dealing with the mortgage, and have the payment that deals with that significant balance. Refinancing. Work with a good mortgage broker, folks. I know sometimes we have friends and families that we've been working with and we trust them, and this is the individual, and this is my guy, or this is my gal, this is the people I work with. Just make sure that whoever you're working with is a professional and can offer you the best rates. Make sure that person's going to really go to great lengths to get you as best as possible the lowest interest rate, right? If you have a great credit score and a stable income, then you absolutely have an opportunity there to sometime negotiate and go back and forth with these lenders. So don't just accept the first rate that's provided. Just consider that you could push back or go to alternative lenders. And that's another thing. Sometimes people have a particular lender for many, many years and they don't want to step outside of that. You may want to consider doing just that, or at least get a second, third, fourth, or maybe a fifth opinion. Because if you have a decent sized mortgage, just knocking off a few points could mean significant amount in the long run, right? So if you're going to refinance, make sure you work with a good mortgage broker. Next one is prepare for job security and business stability. So you want to enhance your skills. You want to network. And it doesn't mean you're going to quit next week or you're going to start, sending out your resume. It just means you start creating that plan B and make sure that you're in a good position as possible, right? Whether you're in a job or even if you have a business, you may want to consider adding an additional stream of income, or create a subscription model. I'm not going to dive too much into this, but just consider creating some type of security within your business, alternatives. It doesn't necessarily mean you're going to change careers or change business. It just means that you're looking to optimize or have a plan B just in case things don't work out. So it's crucial to maintain a stable income. It's crucial to look at your business and to make sure that you're doing as best as possible. But quite frankly, you want to look and see what you can do to, have an upward trajectory, and also consider what potential challenges you may have in your career or business and plan for it. Start to have conversations. Always speak with a recruiter. It doesn't necessarily mean that you're going to get a job, but just get a sense of what's out there. And if there are certain opportunities, what would you need to do to qualify? Just start feeling the waters at a minimum, and where you can, if you can, enhance your skills, invest in yourself. It's an opportunity to do that, right? So you definitely want to do that. Lastly, you want to consider additional income streams. And the way I always look at this, I always ask people what their skills are. What are they great at, but they're not getting paid for? And see if there are things you can put in place to generate additional income, and supplement what you already have. Especially if you have a shortfall, you absolutely want to consider this. You want to have additional streams of income to put yourself beyond breaking even, and where you can just create a really good safety zone, right? There are tons of suggestions. You could freelance work, part-time job. If you have a home and you have a room that you're not renting out, potentially you could rent out that room, rent out that basement. And these are things you should be considering anyway, right? So as we see, these are the 7 suggestions. It's not an end all be all, but it's just some information for you to get going. And the last thing I would say is speak with a financial planner. And that's right, because a financial planner / financial advisor could provide you with a personalized plan that could create that structure in which to follow. I know when you're working as your professional, your business owners, you have all these moving parts. You have kids, families, you have all these things going, and the last thing you want to do is sit down and create a plan. Well, it may make sense to sit with a financial professional who's going to help you create that plan, create that structure, and help you and guide you to that path that you want to go. Consider it like a GPS, where you tell the individual where you want to go in terms of, okay, I just want to feel like I have enough emergency fund. I feel like I want to have enough safety. I want to feel like I have enough for retirement. I want to deal with this retirement planning aspect of things, or maybe estate planning, whatever it is. But with all these moving parts and all this stuff that's happening globally, I might be a little bit anxious, and I just want at least some certainty in my actions, at least the actions that I need to take. And if that's where you are, it's a great time to consider working with a financial planner, because a financial planner, and when I say financial planner, I mean someone who's going to give you a written plan on document that they could email or print, not an investment statement, or not just something flimsy. I mean something that covers all areas from a holistic standpoint, that gives you structure on what you need to do. It's a GPS where you say, this is where I want to go, and this is where I am, and then you have that individual sit with you and show you the different options and different paths you can take to get there. Now, I know that in the last couple years we have had significant challenges here, and hopefully this is helpful to ease one of those challenges, which is interest rates, right? And for other topics that we have, check out other videos, and I will continue to provide you with information like this. Like, share, and subscribe. Until the next time, take care.